CEO of Ryanair, Dave Calhoun, CEO of Boeing. Huge order, up to 300 737 MAX 10s, list price over $40 billion.
Which includes over 300 Boeing 737 MAX aircraft, represents the largest order in Ryanair's history. What does this mean for Boeing and the aviation market as a whole? Why is Ryanair considering canceling the Boeing order? Trade wars and tariffs. As you may know, Ryanair has long been known for offering some of the lowest fares in Europe. However, this could soon change. The airline is now facing a critical juncture as tariffs imposed by the US on European goods have driven up the costs of aircraft. Ryanair argues that these added tariffs not only make aircraft more expensive, but also directly affect their competitive edge in the market. But here's a question. If Ryanair walks away from Boeing, where will they turn? The answer could lie in COMAC, the Chinese aircraft manufacturer. But can COMAC provide a viable solution? Or will new challenges emerge? The possibility of switching suppliers. If Ryanair can't find a way to alleviate these tariffs, they may pivot toward Chinese-made aircraft. COMAC, with strong backing from the Chinese government, can offer aircraft at a much lower price than Boeing or Airbus. But can COMAC meet the high standards demanded by European aviation authorities? This transition wouldn't be easy, as changing aircraft suppliers in the airline industry is a significant challenge. So, what will Ryanair do if they choose to switch? Will they stick to their budget-friendly routes, or will they face unforeseen hurdles? Impact on consumers and the market rising costs and ticket prices. Now let's look at how this situation might affect the passengers. Could switching to COMAC result in higher ticket prices? If Ryanair has to absorb the costs of changing suppliers, it's very likely these costs will be passed on to the consumers. So, what does this mean for Ryanair's reputation as a low-cost carrier? Will their ultra-low fares become a thing of the past? This could be a significant shift in the airline's business model, job losses, and reduced production. We can't ignore the massive impact this decision could have on the aerospace industry. If Ryanair cancels its order with Boeing, the company stands to lose a substantial revenue stream, which could lead to reduced production rates and even layoffs. Thousands of jobs could be at risk, especially in Boeing's manufacturing plants. What will Boeing do to compensate for the loss of this vital deal? Will they find another major partner to make up for the gap, or will we see a financial shock to the company? Changes in the global airline market. If Ryanair decides to move forward with COMAC, the global airline industry could be shaken to its core. Boeing and Airbus would face fierce competition from Chinese manufacturers, which could lead to significant shifts in market power. This isn't just about lower prices. It's about a broader reconfiguration of the airline industry. How will other airlines respond? Will we see more companies follow Ryanair's lead? Or will this be a unique move? The answers to these questions will determine the future of the global aviation market, the financial numbers, and the impact on Boeing. The value of the contract. So, what's at stake for Boeing if this deal falls through? This $30 to $35 billion contract is worth approximately 1 to 1.5 years of Boeing's commercial aircraft revenue. Losing this deal would be a massive blow, both financially and in terms of reputation. Boeing would have to scramble to find new partners to replace the revenue generated by this significant contract. Stock price forecast. Financial experts are already predicting that if this contract is canceled, Boeing's stock could drop by 5 to 10%. This would be a major setback for the company, leaving investors questioning the future stability of Boeing. Will the stock recover quickly, or is Boeing facing a prolonged period of uncertainty? Lost revenue and profit. Boeing stands to lose as much as $20 billion in revenue and anywhere from $4 to $7 billion in profits if this deal is canceled. This isn't just pocket change, it's a catastrophic financial hit. How will Boeing manage to make up for this shortfall? Will they be able to secure other deals of equal value in the near future, or are they headed for a period of financial struggle?
Costco chaos, kilometres of gridlock.
It's just crazy.
As shoppers waited hours to get in the doors.
Completely impatient, like you had to hold your ground.
2.5 hours almost.
Consumer confidence just saw its biggest drop since August 2021. Intel is cutting 15,000 jobs. Costco foot traffic is down 2.3%. Spending on essentials is up 4.3%, but electronics have plunged by 6.8%. A chilling warning from Costco's earnings report. Costco's Q2 2025 earnings came with a surprise, and not the good kind. Yes, revenue rose by 4.2%, but same-store sales, the key measure of real performance, only grew 1.7%, well below the expected 3.5%. The result? A near-instant backlash from investors. But here's where it gets serious. Customer visits dropped 2.3%, the first decline in nearly 4 years. Even more worrying, renewals for executive memberships fell by 2 percentage points, now sitting at 90%. Remember, membership fees make up 75% of Costco's operating income. If loyal customers hesitate, this business model begins to wobble. Consumers are clamping down hard. What are Americans buying now? Not TVs, not new appliances. They're buying groceries, paper towels, basic goods. Essential spending is up 4.3%. Big ticket and electronic sales are down 6.8%. 58% of shoppers are buying fewer non-essentials than they did 6 months ago. 72% now consider warehouse memberships a necessity, not a luxury. This isn't just penny pinching, it's a clear shift in mindset, from comfort spending to financial defense mode. And it's happening across all income levels. Costco's value fortress is under pressure. For years, Costco's value-driven model was bulletproof. $1.50 hot dog and soda combo, $4.99 rotisserie chicken Kirkland signature products that beat national brands on both quality and price. With 850 global locations, including 591 in the US, Costco thrived on everyday low pricing and stock up and save events. But now, shoppers are buying less, even when the price is right. Smaller carts, fewer visits, less urgency to stock up. The message is clear. Even unbeatable value loses its pull when wallets are tightening. A retail crisis sweeping the nation. Costco's not alone. The retail sector is flashing red. Bed Bath & Beyond, from 1,500 stores to under 350. 45 more closing. Soon Best Buy, 3,500 layoffs. Gap Inc., 400 job cuts. Walgreens, shutting 1,200 stores over the next 3 years. And it's not just retail. Intel is slashing 15,000 jobs. Goldman Sachs is cutting 3,200 positions. Hasbro is letting go of 1,900 employees. Meanwhile, the Consumer Confidence Index just logged its third straight monthly decline, the steepest since August 2021. The Wells Fargo Housing Index fell to 35, from 51 just 6 months ago, reflecting fears of high interest rates and shrinking affordability. This isn't a slowdown. It's a broad-based economic retreat. How Americans are trying to stay financially safe. People are adjusting quickly and wisely, eliminating high-interest debt, building emergency savings, diversifying investments across safer assets. More households are moving 5 to 10% of portfolios into precious metals like gold and silver. Income-producing real estate is gaining attention, as are dividend-paying stocks with predictable cash flow. Among those responding fastest, 77% of Gen X and 81% of baby boomers plan to cut spending further in the coming months. Meanwhile, younger generations may struggle more, with fewer savings and more emotional spending habits.
Republican presidential candidate Donald Trump attended a campaign event in Pennsylvania Monday night, a roundtable where farmers and manufacturers expressed their concerns about the farming industry. It was here that Trump says farming company John Deere will have to pay strict tariffs if he was reelected.
600 people lose their jobs. Revenue drops by 18%. New machine sales fall by 40%. John Deere moves to Mexico, threatened with 200% tariffs. Costs rise by $500 million. Old machines become a lifeline. What's going on? The shock from an agricultural icon, John Deere, a nearly 200-year-old name that once symbolized the strength of American agriculture, is now retreating in its own homeland. On May 30th, the company quietly closed multiple factories in Iowa, Illinois, and several other states. 600 workers lost their jobs, and sadly, some only found out via email. Just a few days later, in Pennsylvania, amidst applause at a campaign rally, Donald Trump declared that if re-elected, all John Deere products manufactured in Mexico and brought back to the U.S. would be hit with a 200% tariff. A strong warning? Perhaps. But John Deere had already acted. They didn't wait for anyone to signal red. They pulled the plug themselves, right where their production heart once beat. No more guessing, No more rumors. This is the truth. Clear, with numbers, with people. While politics continue to argue, the workers silently left. Struggling farmers, old machines. Take the lead. It's not just the factories closing. Out on the fields, everything is changing as well. New machine prices are soaring. Tariffs are piling up. Interest rates are sky high. American farmers have no other choice. They are forced to return to machines that are 10 to 15 years old. Old machines suddenly become a lifeline. Sales of new machines dropped more than 40% in just 3 months. A troubling figure. But it doesn't stop there. A basic hydraulic hose, a fundamental component, now takes up to 6 weeks to be available. During the growing season, a 6-day delay can ruin an entire season, let alone 6 weeks. And then that fear spreads. From the fields to the co-op boardrooms, from factories to banks. It's no longer an economic crisis, it's a psychological crisis. The fear is creeping everywhere. Remember 2018? The trade war cost farmers over $27 billion in exports. And now that scenario is coming back. Faster, stronger, deeper. The reaction and the clash between policy and reality. Trump didn't stay silent in response to John Deere's actions. He declared, "Any company that moves jobs overseas deserves to be taxed to the bone." The audience applauded loudly. The crowd cheered with excitement. But inside the factory, the atmosphere was entirely different. No applause, no smiles, just silence, heavy with tension, and empty stares. Because they understood. They were stuck. On one side was the slogan, "Made in America." On the other, costs, tariffs, canceled orders, and a crippled supply chain. John Deere has not betrayed America. They remain committed to investing $20 billion in the U.S. over the next 10 years. But just this year, they've already incurred an additional $500 million in costs due to tariffs. Think about it. How can you invest in the future when you can't even survive the present? Standing at a crossroads. One path is loyalty with losses. The other is cutting back and surviving. What would you choose? The ripple effect spreading across the supply chain. Don't think this is just about John Deere. It's not. The system is shaking. In Minnesota, 3 major dealers canceled their annual sales events. In Nebraska, the co-op cut all financial support for purchasing equipment. Indiana is sounding the alarm. The farm foreclosure rate is skyrocketing at a pace not seen since the Great Depression. The agricultural production chain is not a series of isolated links. It's an interconnected system, from growers to factories to banks. One broken link and the whole system collapses. What's happening now is no longer a few cracks. This is a domino effect in motion, step by step, systematic. And now the question is no longer, how will John Deere manage? The question is, if such a huge corporation has to pull back to survive, then what chance do smaller businesses have to stay afloat?
Donald Trump has told a rally at a U.S. steel plant in Pennsylvania that he intends to double U.S. steel import tariffs to 50%. The president said the increase would offer the country's steel industry more security and vowed to stop any countries getting around the new rate.
We are going to be imposing a 25% increase. We're going to bring it from 25% to 50%, the tariffs on steel into the United States of America, which will even further secure the steel industry in the United States. Nobody's going to get around that.
Steel tariffs rise 50%. 5 U.S. giants halt lines, raise prices, cut production. Ready to discover why? Steel tariff policy and the unstable context. Did you know? The U.S. steel import tariff has surged to 50% in a short time. This major decision aims to protect the domestic steel industry from massive pressure by cheap imports. But has everything gone as planned? In reality, instead of stabilizing steel development, this tariff policy has thrown many big companies into turmoil, facing unprecedented difficulties. Not stopping there, the government has delayed imposing a 50% tariff on goods from the European Union due to stalled trade talks with no progress in sight. So, what do you think when a policy meant to be a shield protecting American industry turns into a double-edged sword? The instability and uncertainty in tariffs have created an extremely difficult environment for businesses. They can't plan production or predict how raw material costs will fluctuate in the near future. Many companies have started turning to more stable markets like Mexico, Vietnam, or Thailand to avoid risks and maintain operations. Tariffs are no longer just numbers. They are major barriers that make every production and investment plan tangled and uncertain. How long do you think this policy can last before its negative effects spread even further? Direct impact on major companies and consumers. Let's take a look at 5 American giants facing heavy pressure from tariffs. Walmart, the leading retailer, openly admits tariffs are squeezing profits. They've raised prices on everything, from essentials to electronics, while cutting thousands of orders and suspending contracts with some suppliers. General Motors and Ford, the automotive giants, withdrew financial forecasts due to unpredictable raw material costs. Ford halted some production lines. GM cut investment plans. Harley-Davidson, the iconic motorcycle maker, moved production to Thailand to avoid import tariffs as high as 60% in key markets. Caterpillar, a construction machinery leader, suffered a $350 million loss in one quarter due solely to tariffs. Their CEO is considering downsizing domestic production to survive. Nike raised prices by $2 to $10 per pair of shoes due to import tariffs from Vietnam, forcing cuts in promotional programs. With prices rising and products shrinking, how do you think American consumers will react going forward? Widespread impact on labor market and supply chains. Tariffs not only challenge businesses, but also directly affect workers and the national supply chain. Many factories have been forced to shut down or cut staff. Contracts are canceled, transportation activities shrink, supply chains break down, and prices keep rising. Do you know that those hardest hit are factory workers and small businesses who rely entirely on stable supply chains to make a living? A policy intended to protect the economy. But is it unintentionally sacrificing essential opportunities and rights of the labor market and consumers? Economic overview and an open question about the future. Tariffs are seen as a political weapon to boost domestic production, but what's the reality? They are causing deep and widespread damage to the U.S. economy. Many big companies are pulling out, not by choice, but to protect themselves from unpredictable policy shifts. Once factories and investments move abroad, is it easy for them to return? The answer is almost never. So, do you think this is the price America must pay for protectionist policies?
Canada says retaliatory tariffs will stay in place until that pause is permanent. CNN's John King went to visit our northern neighbors as part of his All Over the Map series to hear what the Canadians think about the president and his tariffs.
Who would have imagined that U.S. tariffs would shake the global economy this much? Countries like Germany, South Korea, and Mexico are scrambling for new trade routes. And Canada has stepped up as an unexpected partner. But are those multi-billion-dollar deals really in play? The impact of U.S. tariffs, a global shock. It's hard to believe, but U.S. tariffs have sent shockwaves across the globe. Since President Trump imposed 25% tariffs on steel and 10% on aluminum, major nations like Germany, France, and South Korea have been scrambling to find ways to adapt. South Korea, in particular, faced the brunt of these tariffs, with its automobile industry hit especially hard. Australia and Brazil weren't spared either, facing 10% tariffs, while Mexico and Canada initially bore 25% tariffs, though Canada later secured an exemption thanks to existing trade agreements. And that's not all. U.S. consumers will feel the impact too. It's estimated that by 2025, every household will pay an additional $1,200 due to higher prices on goods affected by these tariffs. For businesses in the U.S., the consequences were equally harsh: disrupted supply chains, rising production costs, and strained relations with major trading partners. Amid these challenges, many nations have been forced to seek new trade routes, with Canada stepping in as a significant player. Canada emerges as a strategic partner. So, why Canada? The answer is simple. Canada quickly adjusted its strategy to welcome new trade partnerships. While there were claims of a $10 billion deal between Canada and Germany, there's no concrete evidence of such agreements in 2025. However, Canada and Germany have maintained strong ties through the CETA agreement, which allows Germany to continue exporting goods to Canada. Similarly, Denmark has found opportunities to collaborate with Canada in renewable energy. With tariffs hitting renewable energy components hard, Denmark has shifted its wind energy exports to Canada, a market with growing potential. This illustrates how Canada is leveraging its open trade policy to become a manufacturing and trade hub. Countries seeking new trade routes. It's undeniable, U.S. tariffs have forced many countries to rethink their trade strategies. South Korea has turned to Canada as a new trade partner through the Canada-Korea Free Trade Agreement, CKFTA, has allowed South Korea to continue trade with Canada without bearing the heavy tariffs imposed by the U.S. This has been a brilliant move, enabling South Korea to keep its automotive and electric vehicle EV battery industries growing while avoiding the damaging impact of U.S. tariffs. And Canada has become the go-to destination for nations looking to maintain growth